Hi everybody, Alex Deploy here from Expert Forex, and in this video we're going to be looking at the magic of using moving averages to make trading decisions. And in the course of the video there will also be two free courses that you can access to expand your knowledge of using moving averages. Now the first course will be a Udemy course. It's worth 54 Aussie dollars, so it's worth quite a bit. It's had 4,600 students review the course and it has had fantastic ratings. So please take advantage of this facility to do this course for free. Also, I'll be offering you the magical moving average trading course with some techniques on how you can trade the magical moving average, and that is also free and fully downloadable from our forum. Now, as you can see on this slide, moving averages make the basis for our most profitable EAs, and there you can see the 7-edge EA, which makes over $100,000 in a year, make money, the moving average multiplier, and so on. So moving averages play a big role in manual trading as well as automated trading. So firstly, let's have a look at the types of moving averages that we can get. And on your screen, you can see a moving average that has been loaded. And what this moving average is actually an average of the closing price of the instrument that we're looking at here, averaged over a certain amount of bars. So if I click on this moving average and we go and look at the properties, we can see that it's looking 12 bars back and taking an average of the price there, and therefore it's like smoothing the movement of the price, and that is where the expression comes from, moving average. So it's always moving, it's always changing, and it's the average of a particular price. Now you can decide where you want to base the price on the close of the price, and we'll look at all the options there, and we can also look at the simple method. Now what I've just described here is the simple method. It looks at the close of the price over the last 12 bars and then draws a line, and the line in fact over time becomes a support and resistance line. So anything below the line is regarded as being bearish or in a sell phase, and anything above the line, as you can see, is in a buy phase. So moving averages have really been very helpful for splitting the area of the chart between the bull section and the bear section, or the buy phases and the sell phase, and that's why they've become very popular. Now there's various means of drawing moving averages, and what I'm going to do is I'm going to just load the other ways that you can do it and just give you an indication what the differences are. And there's no right or wrong setting to use. It depends on whether the settings meet your requirements as a trader. So let's have a look. I'm going to load another EA on here, and in this case I'm going to use 12 as the, and this case I'm going to use the exponential EA moving average, and I'm going to differentiate it, I'm going to make it a blue color. So there we go. So now we can see the exponential moving average is sometimes slightly more sensitive. Can you see it's more sensitive there, and so on. It's not too far from the simple one, but it gives you more sensitive readings in certain cases. And if we now change this, and we change this from exponential to smoothed, so this smoothing makes the moving average a little bit, averaging a bit smoother. So let's have a look at that. Now here you can see quite a big difference. There's the actual one based on the simple method, and here is the smooth one. Now here you can see quite a big difference. Firstly, if we look at this type of signals that typically take place, is when the price moves from a buy environment into a sell environment, that is when there is a sell signal, because when it crosses over the moving average. Now look where the sell signal happened here, and look where the sell signal happened here. So the smoothing has resulted in later signals, and what we call that is lagging. It lags more, so it's giving the signals later. And then the conventional EA. So for instance, here again, you can see there's the signal, here's the signals later, and so on and so on. So so again here, look how early the conventional one is, and look how much later the smoothed one is. So each type of moving average has its function. The one delays the signals, and the other one increases the speed of the signals. And what you need to do is you need to play around with those to find out which ones you like best. I actually just like the simple one, but there are a lot of people that prefer the other type. So let's go and have a look at the and one more type. So we've looked at the exponential, we looked at, and then we've had the linear weighted, and let's see what that one looks like compared to, and it's very similar, but notice it gives the signal a little bit earlier. The prices cross a little bit earlier, so it gives the latest movement more weighting, and you can see that the signals are a lot earlier than the red line, which is the simple moving average. So those are the small differences between the types of moving averages. You need to be aware of them because they each have a little bit of a function. If you want your signals to be faster, you could use the weighted moving average. If you want to have them slower, you can use the conventional one, or if you want them even slower, you can use the smooth one. So those are the kind of options you have, and I've used the same setting for all of them. Now, so I'm just making you aware of the types of moving averages. Again, not important which one, there's no right or wrong, as long as you use them for the right purpose, and also as long as you use them consistently. So if you're going to go for exponential, use exponential for all of your trading. If you're going to use for simple, use it for all, so that your decision making is constant. Okay, so let's have a look at some more aspects of the moving averages, and I'm going to just delete this one. We don't need this one anymore. And here we're back to the simple one. Now, the moving averages can be based on different criteria. They can be based on the close, or the open, or the high, or the low, or the median, and so on. And again, there's no right or wrong setting here, as long as you use them consistently and you are aware of why you're actually using it. Again, the simple approach is to just use it on the close. But there are some interesting techniques that you can use here. For instance, what I like doing, and I'm just going to show you quickly, I'll just open another moving average on this. What I like doing is I like using the sell signals based on the highs of price movements and the buy signals on the lows of price movement. And I'll show you why I do that. Let's indicate a moving average. And so I'm going to use the same indicator, and this time I'm going to go for the high. And we put that in. Now, can you see, if you're using the high and you're using for sell signals, not buy signals, sell signals, you get your signals a lot earlier than the conventional moving average. There's a sell signal, so it's a lot earlier. There's a sell signal, a lot earlier. There's a sell signal. Look how much earlier that is, a whole candle earlier. So now the buy signals happen on the low of the candle. So when the price moves over the green line, you would then buy. So it accelerates the entries for buys, and it gives you an advantage because look at the gap between the highs and the lows. Okay, so that gives you an idea of the types of moving averages you can use and what you can base your moving averages on. I'm just giving you an overview at this stage. So let's get rid of some of these indicators we don't need. And now the main signal for a transaction using moving averages is when the price closes under or over the moving average. So for instance, here's a buy trend happening here, but the moving average crosses over. It closes below the moving average, which signifies a sell transaction, but it soon reverses and starts buying. So that's what we call a whipsaw. You've been caught, you've been enticed into going into a sell, but the market actually continued moving up. So that's a whipsaw. So we want to avoid whipsaws as much as possible. So there's various ways you can avoid whipsaws, and whipsaws are basically false signals or too sensitive signals. So one of the ways is to make your periods a little bit longer, but slacker. So let's just, and instead of using another one, I'm going to instead of using the existing one, I'm going to just use another one again, and I'm going to put this as 80, and it will be green, so that's fine. So now I've and it needs to be on the close, and it also needs to be on the simple. So now we're comparing the simple on a close at 12, and we're comparing it with a 15, so they are more or less. So now what's happened is the moving average has gone, let's say, slacker. So it's giving signals a little bit later, and that is how you avoid whipsaws. Can you see that whipsaw that resulted, that I've just shown you there, is no longer a problem because the moving average is slacker. So when we say slacker, less sensitive. So that's how you control your settings. So if your settings are less sensitive, you'll have fewer whipsaws, but your entries will be later than before. So that's how you control, and you have to experiment to get the best balance between whipsaws and late entries. That's the key thing. So there's one way of avoiding whipsaws. The other way, and I'll just use the same one, and I'll put it to 12 so that it's the same as the other one. The other way is to use offsets or shifts. There's the shift. So what I'm going to do is I'm going to just shift this one by 4 spaces. So what it does, it takes the moving average and just shifts it 4 spaces, and you will see how that. So it's identical moving average, just shifted. So let's have a look. Okay, there we go. So what's happened here is that the actual signals don't change too much and are more secure. But look at the whipsaws. There's a whipsaw eliminated. There's a whipsaw eliminated because we've moved the moving average a little bit forward. So moving the moving average a little bit forward eliminates whipsaws, and that's really very important because you don't want to go into the wrong direction and then it reverses straight away. Here's a few more examples of whipsaws. There's a whipsaw that would have happened. There's a whipsaw that would have happened. By advancing it, we no longer incur that whipsaw, and that it makes it slightly later, but again it's a balance between later entries and whipsaw entries. This is by far our best solution to whipsaws, and that actually constitutes the magical moving average, where the magical moving average is shifted forward, in fact, for four spaces or 4 candles, and that has that makes a huge difference to the results that you'll get when you're trading moving averages. So what we've just covered are the challenges when using moving averages. Firstly, the whipsaws that I've mentioned. You've got to get a balance between sensitivity resulting in too many whipsaws and late entries, which results in fewer whipsaws but later entries, and that's the balance. Those are the challenge, to get the balance between whipsaws and the lagging nature of moving averages. Now the remedies for that, and as I've shown you, are using different types of moving averages. So in other words, some are more sensitive, other ones are less sensitive. So you need to balance your whipsaws and your lagging signals by using different moving averages, or you can use the offsets function, which I personally would recommend quite strongly. Then the other thing that we realized as traders very early in our careers is that the moving averages, and this is very important, are best used as exit signals rather than entry signals. So you would use your other means of entering trades, and now my particular favorite was trend line violations, but you could use support and resistance bounces. You can use all kinds of other ways to enter, and the momentum indicator RSI is also a really great one to enter. But to exit, I would use the moving average. So let's have a look at that. Maybe I can give you some examples of that. So that's another remedy. Don't get involved in whipsaws and lagging. Use your moving averages as exit indicators, not as entry indicators. So here's an example of using the moving averages as exit indicators. So you would enter, for instance, over there, you would stay in the deal until the price moves over the moving average. So you do end up giving back an amount, but it isn't over time. It is one of the most efficient ways of exiting. So again, you in a sell there, you don't have to think. You only need to watch the moving average. When it goes over that line, that's when you exit. Those are, and yeah, again, you buy there, you just stay and look out. Keeps you in the trade, and you get out. You are giving back, but it's still over time the most efficient way. And again, here's one, keeps you in the deal all the time, and you get out when it crosses the moving average. And even this one, yeah, look how it kept you beautifully in the deal, and you only exit when it moves over the moving average. So that's the alternative. Use other means. In this case, you could have used a trend line to enter, something like that. You use the trend line violation to enter, and you use the moving average to exit, that type of thing. So those ideas, how you can balance the risk between whipsaws, false signals, in other words, and late signals, and also avoiding that whole argument by just using them as exits. So let's have a look at the signals that you get from moving averages. Now there are many, but I'm just highlighting the main ones. Firstly, when the price closes over or under the moving average, then it's showing that the price is moving into a new phase, either into a buy phase or a sell phase, and that would constitute a trading signal. And let's go and have a look at that one. I've already mentioned it and shown you, but let's have a look at it on the chart. So in this example, for instance, there the price has gone from a sell environment and it then moves into a buy environment, and you would then purchase there on the close of the candle, and that would be the way that you would enter and exit trades. So again, you would stay in the trade, and look how the moving average keeps you in the particular trade. Now the next signal is one that people don't actually pay attention to, and it is possibly the strongest signal, and it is the angle of the moving average. In other words, if the moving average is pointing up, you should be buying. If it's pointing down, you should be selling. So let's have a look at that one. Okay, so here's an example. So what we said is that as long as the moving average is pointing up, you buy. So there it's pointing up. Look at that. You buy. And then when it starts pointing down, you sell. And look at that. And what's nice is the angle stays constant. So you don't have many whipsaws. So this is another way of avoiding whipsaws. So you go, boom, it's pointing down, and only there does it start pointing up again. And then you just continue buying. While it's pointing up, you just continue buying all the time. And then while it's pointing down, you sell, and so on. And you can see how this technique keeps you in trends for a very long time. Very effective way of trading the moving averages. Then some traders use the moving averages purely as a trend guide. So they wouldn't actually trade them, but what they would do is they would put a very long moving average on the chart, maybe a 30, maybe a 50, maybe a 200, and they would say as long as those moving averages are pointing in a certain direction, that is the direction of the trend. Now remember, these are not trading signals, they're just indicators of trend. So for instance, let me add some indicators here. moving average, and we said 50. So 50 would be 1, and I'm just going to make that an orange color, and we say okay. So they would take that as their trend indicator, or they might add 50, you know, and they also be very specific about whether it's exponential and that type of thing. You need to create your own, and I'm going to just put 200 as a number here, and we have green already, so I'm going to put brown. And so what they're saying is the long-term trend here is down, and therefore you should only take sell signals. That's basically what that means. So the long-term trend is down, and that's what they use as the trend guide. Then certain traders use it as a phase indicator, which I've already shown you. Basically, if the price is above the moving average, it is in a buy phase. If it's below the moving average, it's in a sell phase. And then others use buy and sell settings for the moving averages. In other words, they use they use the high setting for sell trades and the low setting for buy trades, which gives them a big advantage in terms of entries and exits out of the market. Okay, so we have a PDF that you can download from our forum. There it is on your screen. There is the link to that PDF. We will supply you with the clickable links in the comments as well as in the description of the video. So please go and download this Magical Moving Average Technique book. It's quite a lengthy one, gives you lots of ideas on trading moving averages. Then, as I've mentioned before, there's this Magical Moving Average trading system, which uses multiple moving average as to identify consolidations, burst out consolidations, as well as consolidating markets and expanding markets and that type of thing. Very, very useful. The course is currently selling for over $50. You can get it free in the next 3 days. It's a limited time offer. Udemy does that, unfortunately, because there's been a lot of misuse of their free vouchers, and they limited them to 3 days at a time on an unlimited basis right now. So please go ahead and register for this course in the next 3 days. You don't have to complete the course, just register for it and you'll be okay. And there's the link to go to that course, and again it will be in the commentary and in the description of the video. Now I hope I've given you some really good ideas on how you can use moving averages to trade whichever market you wish. You don't need to only use them as entry indicators. You can also use them as trend indicators. You can use them as exit indicators, and you can use them to identify the nature of the market, as I said recently about the multiple moving averages. So they are incredibly easy to use, and in fact a study was done over the last 100 years of the stock exchanges, and moving averages were still found to be the most effective indicator for trading the stock exchanges over the last 100 years. So from me, Alex Deploy, cheerio.